Ladies and gentlemen, welcome to this special interview. Today we have a returning guest to the show, Simon Popple of the Brookville Capital Intelligence Report, located at brookvillecapital.com. And I got to tell you, everybody by now knows that the big institutional money is coming into gold, silver, and the miners. And a lot of people are saying buy, 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 but they're not saying what the pitfalls are and what the common mistakes could be. So I emailed Simon and I said, Simon, let's put our heads together. I'll talk about the general trading aspects of it. You can talk about your expertise in the mining sector, and we'll come up with some things that new and veteran traders do in making mistakes in trading these markets. Simon, I'd like to thank you for joining us again on Silver Doctors.
Great to be here.
Now, Simon, it's awesome. This is great times because, we've got the green lights in silver. We got that from Eric Sprott and that massive PSLV announcement they made a couple months back. We got that big, massive announcement and that 10F filing from Berkshire Hathaway showing their huge stake in Barrick. So what's coming next is just this massive gold fever on Main Street like we've never seen it before. So that's coming. So what I would like to do today is take a step back from our own experiences and our own expertise and just talk about kind of the top mistakes that new and even veteran traders can fall into. We'll see where this discussion leads. Does that sound like a good plan to come up with here, Simon?
Yeah, tremendous. Let's do it.
Okay, so a lot of people don't know this, but I would consider myself an amateur trader. I'm not a professional trader, although I have blown up a trading account. So, I have some of the prerequisites there if I need to. But, off and on through the years, I have actually been a trader. So I haven't placed a trade in a couple of years now. But I do know a few of these things one way or another. And what I'm going to do is share some of my common mistakes that I've made to hopefully help people avoid making these mistakes in the first place. I'd like to get your input on these mistakes, and then we'll talk about some things that are specific to the miners after that. So the first point that I wanted to make is just, knowing who you are as a trader and the mechanics of actually trading. I mean, you would think that these things are like, kind of like given, right? They're kind of like freebies, but a lot of people don't understand this. Like, what kind of a trader are you? Are you a day trader? If you're a day trader, are you really going to go up against the HFT algorithms with super fast connections to Wall Street? That's not really the kind of trading I would look at. Are you a swing trader? Now we're talking a little bit more where you're taking advantage of swings and pivots and things like that. Are you a trend trader where you're looking for the move to already have started and then you're looking to get on the tail end of that move? So there's lots of different types of traders out there. And then even just knowing how to trade in these markets, do you know what the difference between a market order and a limit order is? Because if not, then you could get into some serious mistakes there. Do you know, do you want to be buying ETFs or do you want to be a stock picker in that sense? So there's just a lot of things that just at the very beginning, before even jumping into trading, what kind of a trader do you want to be and what are the kind of markets you're interested in? And then piggybacking on that would lead me into my second point about trader psychology. And these are just little things that once a person starts getting started, they do a couple common mistakes. And I did this myself. One of the things is trading too much. When fees come into play and trading too much comes into play, part of that has to do with, if you're making too many trades, they're just racking up fees, and the brokerage firms love that because they're just making money off you and you're not necessarily making money off of the trades. So that's a point there. Also with trader psychology, especially for newbie traders, if you get a couple of wins out there, all of a sudden, it starts to feel good. So you take a little bit more risk. And then all of a sudden you start to feel like, you're invincible and you get this ego coming up and then you take a little more risk. And then that's when the blow-ups happen. So I'm just going to stop there and let you add your input just on that first initial setup there, Simon.
Yeah, absolutely. Well, I mean, I think the junior miners are, they're perfect for traders really, because I think traders have got certain qualities, they like volatility. You need patience, you need discipline. And, I think you need a system as well. And so, if you're going to get involved in that market, then I think the first thing I'd say to anyone looking at the juniors is you've got to diversify. Some could really work out tremendously well for you. Some can go up 10, 50, even 100 times in value. But others, they can crash and burn. So you do need some diversity. And, they can move dramatically. They can move 10, 20% up and down, literally overnight, sometimes even more than that. So you kind of need to understand why you're doing what you're doing. And I think that's just really essential for a trader in any area of life, because if you don't understand what you've invested in, then when you get this huge volatility, you can easily sort of switch out of your position when you should actually be staying in it. And I think there's a guy called Jesse Livermore who's one of the kind of veterans of the trading world, and he said he made most of his money sitting tight, doing nothing. And I think that's very true. If you can just, as you alluded to earlier, don't trade too often. If you've got a position that you really like in a stock you really like, which with a future that you think could be fantastic, just stick with it. It could go up and down. If it goes down and you sort of love it, you could always buy a bit more. Just keep the discipline and keep the vision.
Mm-hmm. Absolutely. And the thing that I'm thinking about when I'm hearing you say that is, don't start going all huge at one time. If you realize that, I've got a good stack of gold and silver coins, safe and secure, that only I have access to, and you want to move into the gold and silver miners, then you start out, smaller. You understand what you're doing, you understand what you're getting into, and maybe you just buy a couple simple shares of a couple of the well-known miners to start with. Moving on here, another one of the problems that I see newbies making here, Simon, is something that I would call too many chiefs and not enough Indians. And what I mean by that is everybody is saying, do this, do that. But, in the end, the one person that needs to do that is the actual trader themselves. And I don't even know if that even made any sense or not. But for example, let me give you a specific example. If you've got somebody who is saying, I'm a trader, this is how I trade, all you got to do is do this. And what they're talking about is like hardcore Fibonacci analysis and hardcore Elliott wave theory and all of this stuff, but you don't like math, well, that's not really what you need to be doing, right? So, if you're an Indian and you're listening to that chief, you're listening to the wrong chief in that sense. So that's one thing. And then another thing about too many chiefs and not enough Indians is too many things on your screen telling you what to do, and I've fallen prey to this myself, where I used to have a gazillion things on the screen, and it's not just a 1 minute chart on the tick by tick, but you got the 50-day moving average, the 100-day moving average, the 200-day moving average. You got Bollinger Bands going on. You got the MACD, you got the RSI on there. So you got all of these different indicators telling you what to do. And then all of a sudden you get to that deer in the headlights moment where, well, you don't know what to do because there's so much clutter on the screen. So that's another thing that I mean by too many chiefs and not enough Indians there. So the point is that, piggybacking on what you said, yes, it's having that system that works for you and understanding that there are going to be people that have different systems out there, and the systems that work are the ones where people say, this is how you develop yourself into a trader. Not necessarily this is what you buy, this is when you buy it, this is when you sell it. Did any of that make any sense at all there, Simon?
Yeah, no, completely. I mean, I use a system, I call it the bridge system, which is an acronym for balance sheet, resources, infrastructure, diversification, grade, and exploration potential. And just keep it simple. I mean, as you said, you just have to have your own way of analyzing things. You need a system that's proven, that works. And just keep it simple and follow your own path. And obviously there's so many ways you can analyze stocks, as you just alluded to, but you need to have something that works for you, that you fully understand, and also you fully understand that in terms of what you've bought and the positions that you've got. Because if you've got a disconnect there, then on the one hand you've got a system, but you haven't bought the stocks because of that system, and therefore you've got this huge disconnect, and that's going to lead to trouble.
Mm-hmm. And what I'm understanding from your system is that, see, this is what I'm getting at, and I think it's what I just heard you say, because it's kind of like, some people out there say, use my system. My system works great, but it's proprietary. But what you're saying is, here's what works for me, and here's how I can teach it so that you can develop it on your own to make it work for you. Is that what I'm hearing there, Simon?
Yeah, no, completely. I mean, the whole idea here is that people, think for themselves. And I mean, I've been fortunate. I've traveled my money in the last 6 months, but what I do is I've got a fancy football format because all mining stocks are different, and so you've got some massive companies which I call my goalkeepers, and then you've got defenders slightly smaller, midfielders probably new to production, and then you've got your forwards which are out and out explorers, and people need to know what sector of the market they're investing in, because if you get 50% from a goalkeeper, you should be pretty happy. If you get 50% from a forward, given the risk you're taking, you should be looking for a lot more than that. So, it's really important that people understand, what they're buying and more importantly, why they're buying it.
Mm-hmm. Very interesting points there indeed. I do like the concept of, having the analogies there, because it helps you look at the certain companies and say, well, where does this company fall in line with the overall strategy that I'm developing? Because here's what it comes down to, Simon, and this is my fourth point here. And this is a point, the topic that I'm going to call, it's a dog-eat-dog world out there, or it's a world of cutthroat competition. And I do think that's true. And here's the few things that I want to throw out there. And this is a thing that, especially for new traders, but it even can happen with veteran traders from time to time, that they fall into these types of, they fall victim to these, is what I'm saying. So, for example, recognizing the pump and dumps, right? People don't understand what a pump and dump is, but a pump and dump is when there's this stock that's got no chance from a company of ever having any chance of doing anything successful, but, they've got some people that need to sell these stocks, and what they do is they, get people to promote these stocks or whatever, and then they go up, and then they're selling into you because you ended up buying it, and then the stock crashes, and then you lose all your money. That's a pump and dump right there. Another thing is some companies pay people to go on and promote their product or talk about their company or this and that. Like, for example, you and me, I emailed you and I said, you know what, we got to come up with something to help traders out. I'm not paying you for this interview. You're not paying me for this interview. We're just trying to help people out here. But you got to be aware that sometimes when people are listening to interviews, that's not necessarily the motive behind it. The motive behind it is trying to get you to buy a stock that somebody else is needing to sell. There's a point there. Another point that I wanted to make about that is when I say cutthroat, people are looking for new traders, especially to make mistakes. And when I say mistakes, one of the things that I mean is, for example, if somebody doesn't understand what a market order is, right, and there's this really thinly traded stock or something like that, someone will put out a super low bid on that. That is just the only bid that's out there because the stock is a poorly traded, low volume stock. So somebody who's losing money on it, who's a new trader, will be like, oh my goodness, I got to sell this stock. They hit sell on the market order, but the only bid that was out there was a super low ball bid, and then they lose even more money because they don't understand the mechanics. So that's another example of what I mean by just the markets are cutthroat. When I blew up my trading account, fortunately, I could afford to, right? I took $3,000 and I ran it up to like $24,000 in less than a year. And I had like $50,000 worth of trades and I wrote it all the way down. And it was a horrible feeling. So, I'm speaking this from my own. I was able to survive that financially and I learned from it. So I'm trying to share these things. But just the point is that it's a dog-eat-dog, cutthroat world out there in these markets. And then you got to add in things like corporate buybacks, insider trading, executive profit taking, splits, secondary offerings, all these other things too that can make your trade go one way or another against you. Do you have anything you wanted to add on to that, Simon?
Yeah, I mean, I think that going back to your overall trading strategy, you really need to understand the companies. I mean, you shouldn't follow too many companies, because if you've got a reasonably small universe of companies that you're monitoring, you'll be aware of a share split or what's happening with that company. They could go ex dividends, so the price goes down. Doesn't bother you because you've got the dividend anyway. You know why the price has moved, and so you really do need to understand the market that you're operating in. And I would urge people to stick to a market they're familiar with. And in my case, I like the junior miners, but other people may have other areas where they want to invest. And I think you do need to be careful. If you made your money trading in a completely different market, and then you just want to bring that skill set over to the junior mining sector, I would urge you to do quite a lot of research before you start chucking your money around, because as you pointed out, even if you follow some normal trading strategies, you could still make some pretty rookie mistakes that come back and bite you.
Indeed, indeed. Another topic that I wanted to bring up with you, Simon, is this whole concept of getting rich quick, because that's what the people think, right? When they start trading, they're like, "Oh my goodness, I'm going to get rich quick. I'm going to have a $60,000 BMW here in another couple months, and I'm going to retire in 5 months." And that's not really how it works, right? But what happens is that people get a couple winning trades going on, and they start getting into that get rich quick attitude. And here's what I mean by that, right? What I mean by that is, someone who just initially bought some shares of a junior mining company and they saw it go up, maybe it doubled in price, but now they're feeling, you know what though, how can I get more? And then they start learning about, the triple levered ETFs, and then they start buying those things. And then they're like, wow, this thing is going up crazy. And then they start learning about options. And then what do? They think that they can get rich quick off of options, so they sell all their shares outright, and then they just end up becoming solely options traders. And that's how I blew up my account. I blew up my account trading options, and I got rid of all my stocks just to trade options. That's how much I got addicted to the leverage of it. So my point is, it's not a get rich quick thing. It is a get rich steadily thing, and it is a get rich conservatively thing, in my opinion, only after you have that solid foundation of the gold and silver physical first. That's one point there. Another point about that is when it comes to the whole get rich quick thing is, these markets can be subject to overt or covert interventions at the drop of a dime, and that can turn everything around on you at the drop of a dime. I remember, several years ago, people thought Deutsche Bank, that was over. It was the end of Deutsche Bank. I threw a couple, put options on Deutsche Bank, made some money. Then I threw a couple more on it. And then all of a sudden it looked like Deutsche Bank got rescued by the ECB or somebody. And then I blew up that account. So blew up that trade. Right. So that's the thing, right? With options, it's very painful when that trade goes against you, because with options, you lose all of your money. You don't even have the shares at that point. So just the whole purpose of that is we're not talking about something that's get rich quick. And, if it's get rich quick that people think, it's really not like that. Did any of that make any sense there, Simon?
Yeah, no, absolutely. I mean, I think the thing is you need a diversified portfolio. I mean, I think ideally, 10 stocks at least. And, some of them will go up a bit, some could go up a lot, but some could go down a lot as well. So, what you're looking at is kind of the average return. And, my report is averaging about 80%, including 4 cash positions. But that's, you need to invest in a broad spectrum, because, some will go down, some will go up a lot. But it's not a get rich quick. It can be quite risky depending on where you're investing and how you're investing. But the returns, if you have a broad enough portfolio, can be pretty good.
Mm-hmm. Indeed. So now I want to get into kind of your expertise, because you've got the Brookfield Capital Intelligence Report, and one of the things that you are pro at is in analyzing the different mining companies in the mining sector and things like that. So just, off of the mistakes in general, tell me some of the mistakes that you see people make when they're actually, because that's the point, right? If somebody has come into this video, then they're either interested in gold, silver, and or the miners. And then that next step into the miners is in fact a logical step, right? It is a logical step after having a core foundation of gold and silver. So what are some of the specific mistakes you see that people can make when they're looking into the miners there, Simon?
Yeah, sure. Well, look, let me, probably the easiest way of explaining it is just go through the bridge system and give the biggest mistake for each of those. So
okay.
B is, your balance sheet. Now, you've got a balance sheet of a producer and balance sheet of an explorer, really. Let's deal with each of them. Normally, you'll have debt on the balance sheet of a producer. And in the past, this didn't tend to be a massive issue, but because of COVID, it could be. So you do need to look at when the repayments are due and their ability to repay If they've only got one or two mines, then they could easily be closed because of the pandemic. A debt repayment that normally would be very easy can become a major headache. So, you do need to look at where they're operating and, about their cash flow and their ability to repay any debt that's coming up anytime soon. The explorer, because they're not generating cash, you don't generally want to see any debt on an explorer's balance sheet. And there are some that do have debt, and the only way you can get rid of the debt is by doing a capital raise through your investors. If it's a small capital raise relative to the value of the company, you could probably get away with it. But if it's a large capital raise relative to the size of the company, you may find that your investors aren't willing to put their hand in the pocket. And if they are, then they can really dilute the company massively, and that can hurt them. Looking quickly at resources.
So it's almost like inflation of the money. If I could cut you off real quick, Simon. So it's almost like we talk about inflation of the money supply. It's almost like inflation of the share supply. So when they're doing these kind of raises, you're basically adding more shares, which could have the effect of lowering the share price, if I understand that correctly.
Yeah, that's right. I mean, basically, if you add more shares to the register, then you dilute the existing shareholders. So you do need to be mindful of that. Mm-hmm. And then I think the main thing on resources is, a company could have quite a high level of resources. Let's just pull a number out the air, 1 million ounces. Now, if that's from one or two deposits, that's probably pretty good. You need to look carefully into it, but generally, 1 million ounces from one or two deposits is there's a good chance it'll be economic. But there are people out there who've got 1 million ounces from 7 or 8 deposits, and they're not near each other. So what you've got is you've got a nice headline resource, but it's not really economic to mine. And so you do need to sort of look under the bonnet when someone's got a decent resource. The I is for infrastructure. Again, you can have a company that's got a fantastic resource, some really nice deposits. But if there's no roads or water or power nearby, it's going to cost them a lot of money to do that. And it may cost them so much money that even though they've got a nice resource, it's not economic for them to mine it. D is the diversification that we referred to earlier. They need to be in quite a few different stocks. Grade, again, higher grade generally is viewed as good, but you do need to sort of be careful and look at the cost of actually extracting the gold or silver or whatever it is from the ore, because on the face of it, it may look like a low grade, but it's a very low cost operation, so it's very profitable. Or it may look like a high grade, but it's a very high cost to extract the ore, and therefore it's not very profitable. And finally, you've got exploration potential. And generally, if you're looking for gold where gold's already been found, then that's helpful. And if there's a lot of potential to explore more, again, that's a positive. But you may have a company that's already done a huge amount of exploration. They haven't found much, and so the exploration potential is very low. So on the face of it, it looks like they've got a nice resource and quite a nice asset. But if they've already kind of ripped it to pieces with a huge amount of exploration, or someone else has, then your exploration potential is not really there. So you may have to look at acquiring other sites, other tenements, where there's more potential.
So now I've got to grossly oversimplify this, Simon, just because that's how mine works. I have to oversimplify it. So here's what I'm understanding. And I'm going to use this analogy because it drives me crazy when I hear people talking about this. Asteroid mining, right? For some reason, people think that they're going to be mining gold from, asteroids in outer space. And I'm thinking, if every couple of weeks there's this news item that says, asteroid nearly misses Earth, amateur astronomer found it, and NASA didn't even see it. Well, if NASA can't even see these asteroids, how in the heck is a company going to go up there and mine one, right? That's one. But there's just so many problems with that in and of itself. But my point is, in that gross oversimplification, just because something is there, that doesn't mean you can get it. Is that big point there, Simon?
Yeah, absolutely. Gold came when asteroids hit the Earth. So, you can't print gold. Gold is if another asteroid hits the Earth, then I think the last thing we'll be worried about is the price of gold. But yeah, I mean, I'm sure there is gold in asteroids, but the cost of sending a rocket up there, mining it, and bringing it back down, that sounds very, very expensive to me. So yeah, you need to look at everything, and I think I wouldn't get too excited about mining asteroids.
Right, right. And my point about that is because, when you said, well, if they got 7 different deposits and they're not close to each other, that's kind of like the same thing, right? So that's kind of why you can't just be blindly picking names because you like the names, but you have to dive deeper with your system to understand what it is that you're looking for in the company. Because sure, they could have gold in 7 different places, but if one of them is in a hostile area that the government doesn't like the gold miners and the other one doesn't have water resources and the other one doesn't have a road, you might want to move on from that company. Is that fair to say, Simon?
Yeah, you need to. I mean, that's why I call it the bridge system. I guess it is a system. You need to look at everything together, because you could have a company that's got 4 really, really nice parts of it, but one very ugly part. But that ugly part, it could be infrastructure, whatever it is, or grade, or resource, whatever it is. But that could be enough to put you off it. So you do need to sort of have a good view at the main drivers of the company, and try and not get too excited about one or several if there's a pup in there.
Awesome. So to put you on the spot here, Simon, just as we get ready to wind it down, so what are some of the things that you're looking at now? What's got you excited? Are you really excited about the juniors? Are you really excited about the majors? Are you really excited about Warren Buffett? Like, are you really just excited about the price action in gold, but are looking at the price action might even be better in silver, since we're still a country mile from all-time record highs? So I guess just my question that I always ask people really towards the end of an interview is, as we're moving into fall here, what are some of the things that are on your radar, Simon?
Well, the thing that excites me the most, to be honest, is that it looks like gold is becoming more and more mainstream. There's more and more people talking about gold. Ohio Pension Fund has just allocated, I think it's up to about 5% to gold. Warren Buffett is bought into Barrick. This is very early days. This may just be a blip and nothing else happens. But if we get more institutions buying into gold, then I think that the price really could start to motor, and the interest in the companies could really start to motor, and that has to be good for people who've already got positions or are going to put positions in place soon.
And tell listeners and viewers a little bit about the Brookfield Capital Intelligence Report and what they can get from it, Simon.
No, sure. Well, it's a weekly report. It comes up with a new idea probably once a month, and then the other editions are really updating you on what we've already been talking about. It's at the moment the focus is very much on gold, silver, and precious metals. We've done very well, and I expect us to do very well over the next few years. But we'll also be looking at other commodities as well. So the whole idea is we've got a really nice, diverse portfolio that we can have a bit of fun with.
There you have it, folks. The Brookfield Capital Intelligence Report at brookfieldcapital.com. Go check it out. Check out Simon Popple's excellent work. Simon, I'd like to thank you for joining us again on Silver Doctors.
Thank you very much.